So talk us through that view in terms of the reaction to yesterday being perhaps not as bullish as some might interpret.
Yeah, I mean, look, think about, go back to the last 3 months. I mean, the market really sold off at the end of last year because the Fed was tightening probably more than people recognize, particularly the balance sheet, something we've been very focused on. They pivoted dramatically in early January. Didn't give us, they've been leaking out kind of every other meeting or every other time they get on the, press conference about how they're getting incrementally more dovish, and they've been surprising us every time they've spoken. Particularly Chair Powell, they've gotten incrementally more dovish. And I think yesterday was kind of the full capitulation on that, where they're now telling us they're going to end the balance sheet reduction by September, something our rate strategist actually predicted last summer. So I think that's all good. That's really good news. The problem is, not a problem, but I mean, the market has been discounting this now for 3 months. We've gone straight up. It's going to be the best first quarter we've seen in quite a while, really going back to 1998. So I think this is not new news necessarily to the market. I would throw something else into the cocktail, however, which is why are they acting so aggressively? Okay, and I think there are reasons to be a bit concerned about growth. That was the other concern we had last year, was that growth was decelerating because the fiscal stimulus was wearing off and because corporate margins were starting to see pressure. I think the Fed sees that. The payroll number was quite weak last month. The output gap is well into restrictive territory. And I think the Fed is just saying, look, we don't know how this is going to play out. Confidence took a real hit in the fourth quarter, and we just want to take out a little extra insurance. Now, the thing that I think the market's going to focus on the most in the near term is going to be earnings. So fourth quarter earnings were very disappointing, I think, relative to what people were thinking 6 months ago. It was in line with our view that margins were going to disappoint. Of course, stocks looked through that because the Fed was very dovish. But now I think if they miss another quarter, if earnings are weak again this quarter, which is our view, I don't think stocks are going to look through that this time.
Do lower rates, though, allow a little bit more multiple expansion? Well,
we've gotten that, right? So 13.5 times is where we got in December. We were very aggressive buyers at that point. Now we're at 16.5 times. And that doesn't seem egregious. However, earnings are still falling. So if earnings are still falling, then the question is, what kind of multiple do you really want to put on that? 16.5 times to us is full. Equity risk premium 3.25, which is where we got, is kind of full. And I will point out, yesterday was very interesting because what happened during the day, even after the Fed made the call, the market rallied briefly, but it was being led by defensive stocks. And it was also, you saw the bond yields really plummet. If the market wasn't worried about the economy, that's not what would be leading on such a dovish message from the Fed.
You like Procter & Gamble, so that defensive-ish stock in that sense. Talk us through that.
Yeah, so we're overweight two defensive areas, utilities and staples, which we upgraded last June, and they've massively outperformed since then. They're still well up against the market since then, and we think that's going to revert back to these defensive areas. With bond yields plummeting the way they are, particularly utilities, they should continue to do well. General Mills put up a very good number the other day, and I just, once again, earnings stability, I think, will be paid for.
In terms of exposure, U.S. versus rest of the world, despite the sort of slowing growth fears from the Fed in the rest of the world, China, you think, has turned a corner a little bit? Yeah,
our call from last November was that China would bottom in Q1. We think we're seeing evidence of that now. It's one of the reasons we're overweight emerging markets relative to developed markets. And look, that's one of the reasons we put LVS on our fresh money buy list as well. It's sort of a backdoor play on the China recovery. There are very few stocks that haven't rallied yet off of that, and we think there are still opportunities there. So, yeah, we're overweight China, we're overweight EM.
Domestically, other than those defensive sectors, are there any more growthy names that you like?
Well, the growth stocks have been the darling in the last month and a half. So initially, it's interesting, the beginning of the year, the rolling bear market from last year turned into a rolling bottom with the weakest things rallying the most, the cyclicals. That's morphed since the January 29th Fed meeting back to the growth stocks. Because there is doubt now about whether or not growth can recover to something, above 2%. And if that's the case and we don't go into recession, then the growth stocks should do better. Our, sort of beef with that is that they're now overpriced, and we think they're a little bit risky here.
In terms of the dollar, do you think that upside is capped? Does that move you towards exporters?
Yeah, so the dollar, our call for this year has been the dollar would be weaker. We think yesterday's message is a move in that direction. However, if the economy weakens again and the earnings weak again, there could be a safe haven bid into the dollar. And if that were to happen, then we're probably going to chop around here, sort of the mid-90s on a DXY basis.